you are providing 2020 profit details in 2040. It should be relevant. No, you can say that, okay, no, I presented my data. Data should be relevant as well. I need data for 2019 and you are providing me data for 2016. Right? It should be relevant as well. Plus, it includes materiality. What does it mean by materiality? Like we just discussed, it should be measurable in terms of dollars or whatsoever currency that you are using. So relevancy and faithfulness, they have the enhanced characteristic. Relevant means why information should be relevant, why faithful, because comparability, it is easy to compare, right? If I want to compare $100 with 1,000 Japanese yen, I can easily compare, right? We have this statement is written in yen and this statement is written in dollars. So I will convert one of the currency into yen and then I can compare. Okay, just give me 1 second. Okay, so we were talking about the enhanced characteristics of relevance and faithfulness. It should be verifiable. So verified by some trusted partners, for example, auditors, right? Signed. So these financial statements are signed by some credible person so that you can easily trust. It should be timely, or timeliness should be there. So if you are in 2022, you must have the 2021 data as well. So you can easily compare. Okay, if you are in okay, let me first erase the data here. Here, timeless means, for example, you are in March 2022. Now, you want to buy shares for this company. And then you need information from the company so that you can make your decision to purchase company share. Company only published data for September 2021. So in 6 months, anything can happen. You have seen in Corona pandemic, in 6 months, many companies, they just wiped out, they just liquidated, they just gone. Many people lost their jobs, right? So business environment is very dynamic. So you want to base your decision right now based on past performance, which is, 6 months ago. It means data is not presented timely. So, and now you are shaky to invest or not because you don't have the data. So that's what we mean by timeliness. And then the last one is understandability, that you must make the reports according to the standards so that it is easily understandable. Everybody can understand that. So that's why we talked in our previous slide that accounting is the language of business, right? Okay, so all these principles that you apply must have a cost, right? You need to hire accountants, you need to hire graduates from Donghua University CIP because they're accountant, right? And you need to pay them salaries to maintain your accounting information system. It has a cost, right? If your business is small, for example, you are operating a noodle shop and you hire an accountant, small noodle shop. then of course the cost is huge and benefit is low. So you don't care about accounting standards. If you're a big food chain, then you maybe then it is more logical that because cost is lower, because they can easily, the accountants can easily maintain the data, maintain the financial reporting systems for you guys, and you can easily understand, okay, how much this month's profit for my company, right? Just pause the video and you can just read that. We just talk about it. Relevant mean make a difference to decision maker, help to predict and confirm value. Be material. Material means it should be written with some kind of measurable currencies. Faithfulness, free from error, free from biases, neutral, be complete. Comparability means you can easily compare from different companies with the same period. You can easily compare the company's past performance as well, right? Verifiability means check for accuracy, completeness, reliability, which comes from some authentic person, right? Timeliness, information made available to user early enough to help them make decisions. Understandability means information sufficient, transparent, so that it makes sense to reasonable, informed user. Right? Okay. Cost. The cost of disclosure should not exceed cost of expected benefits. Like we talk about the example of simple noodle shop versus the big chain of noodles. Now, assumption and principles. So accounting principles, the GAAP and IFRS, it is based on these four assumption and principles. Number one, entity assumption. Entity assumption means that organization stands apart from other organizations and individuals as a separate economic entity, which means honors are not so honors business, if business make an income, that doesn't mean that honors make an income. So these two are separate entities. Honors are different, business is different. In the eyes of law, these two are different units, different individuals. It would be taxed differently, it would be taxed differently. Right? Two, continuity assumption. You can die, but you just won't die.
Sorry. For the entity assumption, does it make any difference for accountants? Because anyways, like organizations and individuals will be separate. So will that make a difference in accounting?
Okay, because we are studying accounting for corporations, because most or 100% of the accounting that we study here in this course will be applicable to corporations. And the establishment of corporation is that corporation is different entity and its owners are different entity. While in other form of businesses, of course, the employees are different from the organization, but in sole proprietorship, in partnership, if business make profit, that is included in owner's income, and owner's income is income tax, which is fairly low, right? In China, for example, my income is taxed only 20%. But if I made a corporation, my income is going to be taxed 40%. And then when company give me rest of the again, it's not working. What happened here? Guys, can you hear me?
Yep.
Yes.
Yes.
Yeah.
Why my controls are just halted? Everything is halted. This Chumu is giving us trouble today. Okay, just listen to me. So the other form of business like partnership and proprietorship, because they are running by the owners. So if you put your 100% effort, your business make profit, it means you make profit. But this is a different case for organization. You put the money and you delegate your authority to run the company by the managers, and you push the managers to work hard to earn more so that company can give you more money. So you will be taxed twice. So in that case, because we talk about that, establishing a company is not an easy job. It has a specific law and it's a hectic process. So normally companies, big corporations, public corporations, they are established with billions of dollars, or at least minimum amount. I think it's mentioned on Security and Exchange Commission. I think I just forgot amount, but it's in millions of dollars, and maximum is no limit, right? So in this case, if managers made a bad decision and make a loss, big companies make big losses, one or maybe 100 billion loss, how you are going to fulfill that? Through your personal property, right? But in case of corporations, the law state that because you are not running the company, companies is run by the managers. So you only lose the money which you have invested in the company, that's it. So your personal properties would not be involved. So in that case, the law segregated company as a separate economic unit, a separate entity, and the owners as a separate entity. Owners are taxed with normal income tax 20%, but the income of the company will be taxed 40%. Right? You understand?
Understood, yes. Thank you.
Good. And then historical cost principles. So if the historical cost principle means, okay, how I can write, I cannot change control, that's amazing. And let me share again. Maybe that way I can. No, still my controls are not working. Okay. We'll start. Okay, the historical cost principle, assets should be recorded at the actual cost. So your business started in 2000 and you bought a laptop worth $1,000, and now, or I think it's a silly example. Let's talk about this. You started a business and you bought a land for the business. For example, you bought a land for $10,000. And now, after 10 years, the land cost increases. With the passage of time, land increases. Now the land is $1 million. So the accounting principles assume that you should record your assets. We'll talk about what do we mean by assets, right? Don't worry about it. Asset, what you possess. We'll talk about the accounting and